Welcome to the Friends with Money podcast, brought to you by Money Magazine, creating financial freedom for Australians since 1999. Please remember that the views and opinions expressed in this podcast are general in nature, and further independent advice and research based on your personal circumstances should be sought before making an investment decision.
Hello and welcome. I'm David Thornton, Senior Journalist at Money Magazine, bringing you today's episode of Friends with Money. August 27 marks the 20th anniversary since the first ETFs were launched on the ASX by State Street Global Advisors. To discuss the journey ETFs have taken since then is Meaghan Victor, Head of SPDR ETFs Asia Pacific Distribution at State Street Global Advisors. We'll go through the rising popularity of ETFs, themed ETFs, and how their key traits set them apart from other investment vehicles. So Meaghan, it's been 20 years now since the first ETF rolled out in Australia. What did the ETF space look like in those early days?
Thanks so much for having me. Look, if you go back 20 years ago, it was a really different environment. Like ETFs they're relatively new on the scene. They'd been launched in the US in 1993 with the first ETF that was launched over there, which was tracked the S&P 500, which is SPY. And so in 1999, the first ETF was launched in Hong Kong, and then 2001 here in Australia. So it wasn't like they weren't new, but it was new to the Australian market. But what we saw at that time was that the type of ETF was a core ETF. So it tracked, the investments options were tracking the top 200 stocks in the Australian market or the top 50 stocks in the Australian market. So they would be core holdings if you think about what we would consider today. The type of investor also that was investing in ETFs back then was more predominantly like self-managed super funds, institutional investors, more of what we would consider today to be like the baby boomers were all investors in those products at the time.
How long did it take for ETFs to gain traction among retail investors in Australia?
Well, it depends on how you define that, because if we think about the original investors in Australia, they were self-managed super funds. So they're mums and dads that are controlling their superannuation. They've decided to make that decision. And they could have been working with accountants or financial planners, but they were the ones controlling their decision and they were right there at the very beginning. So back 20 years ago, and a lot of them are still there today as well. So I think the definition of traction, has morphed over time. And I think that has come with the size of balances that people are investing in ETFs. And also the choice and the options that are available. So if we look today, like younger investors are really in retail, are really grabbing hold of ETFs. And we've seen that predominantly over the last couple of years. So it has definitely changed. I think a lot of that's driven by choice and technology as well.
Have ETFs taken market share away from traditional managed funds, or are they two different groups of investors, do you think?
I would suggest to you there's a place for all types of investments, and it depends on what people are looking for by way of the ability to implement the structures that they sit within as well, because you've got to remember that an ETF is a structure around a bunch of shares. You can either buy the structure is either tradable on the exchange, which is what an ETF allows you to do, or it's a managed fund, which is managed by a professional investor. And the paperwork's different and so forth as well. So look, I don't think they've taken market share away. I think what we've seen is the market evolve. And that evolution is not just around ETFs and managed funds and LICs and LITs and so forth. It's also about how they're actually packaged up. I think what we've seen has been how they've been used. So more of them are going into managed account structures now and model portfolios and those sorts of things. So I wouldn't say they're taking it away, no.
So just coming back to that term traction and how it means something different depending on how you define it. How have ETFs been accepted by different professionals in the industry, from advisors to robo-investors to managed accounts, as you say?
It's definitely taken time. And I think if you look at the financial advisors, because it's a listed security, some advisors had not in the early days been able to use them because they had to be able to be licensed. They had to be licensed to be able to provide advice on securities. So that did. But we've seen a lot of that change today, and we've seen that we've seen financial advisors' adoption and support of ETFs has really grown. But then we morph, as you say, there's been that the innovation that's come that the ETFs allowed been able to support through technology. So you've got groups like robo-advisors like Six Park and StockSpot, and they're constructing low-cost model portfolios that are actually available to be implemented over through technology. But then you've also got groups like Pocket. So CommSec Pocket has also made ETFs that a bit more accessible again for that investor who has only got, say, $25 a month that they want to invest, or $50 a month. They can now buy one share in an ETF as well. So I think that's changed the take up from a financial advisor, because financial advisors can also use ETFs and model portfolios in their businesses, as well as the retail investor as well.
Now, with the majority of ETFs, at least as far as I'm aware, are passive ETFs. The passive nature of them and the rules that they operate by, has that allowed ETFs to dovetail with improvements in technology, as you mentioned?
It's a great question, because I think that not all ETFs are passive. So they track an index. So if we think about mirroring an index, ETFs do that. I think the adoption of technology, I think that part of that adoption's come through low cost. If we think about the model portfolios and the robo-advisors, a lot of it's driven by cost and accessibility, rather than necessarily the structure. So that's not to say that an active ETF can't also be part of those portfolios as well, because we've seen that does happen today. I think it's more the cost and the ability to implement and the structure that sits around an ETF, rather than just whether or not it's passive or an active ETF.
Let's talk now about ETFs themselves. What have been the key selling points over the past 20 years as you have seen them?
So we can talk about there are a bunch of features that sit around an ETF, but I think the key thing is to say that they are low cost, which I mentioned. They offer diversification, so it gives the investor the ability to buy, say, an exposure buy the top 200 stocks in one trade. So they're getting diversification in a single trade. They're transparent. So at any day, you can actually jump online at any of the issuers' websites, and you can actually see what the underlying portfolio holdings are that you're holding today in your portfolio. So you can identify all of those companies that you're investing in. And when we talk about they're flexible as well. So unlike some of the other investment structures, you can buy them today. Like you can buy and sell quite quickly as well. So that comes back to the liquidity of the investment in your portfolio.
So let's talk about the rise of thematic ETFs. It seems every week sees the introduction of a new thematic ETF. When did they come into the picture, and how much of the market do they represent?
Look, I think the ETFs have evolved, as I said to you before. So we've gone from core, and then we've started to see smart beta come into play. But thematic ETFs have really diversified the offering for investors today. Now, we could say the first lot of thematics that came in were the resources funds and the property funds and the financial services funds. That were the base level, and they were out about 10 years ago. But now, as you say, we're starting to see hydrogen funds, and we're seeing you can invest in the FANGs, or you can the choice, or oil. The choice is absolutely there, along with commodities. Now, the structures actually, the ETF structure has allowed that to happen. In the main, they're physically backed investments that people are investing in as well. But the market share is growing. If we look at the Australian market and the way in which investors today are investing, they're investing predominantly in global equities, and then there's a bias to Australian equities. So therefore, they're still not necessarily 100% of an investor's portfolio. They're going to be that small proportion from a diversification perspective of a portfolio.
So the majority of ETFs still are those broad market ETFs?
Very much so. But we're starting to see growth in things like ESG. So we've seen the ESG truly grow, particularly in the last 5 years here in the Australian market. And that's because people are looking for an option to be able to invest and follow their values through to their investment portfolios, and making sure that they can actually see that play out without compromising on their investment returns and the risk profile of their portfolio. So we are seeing that grow more broadly.
Now, it's not all good news for thematic ETFs. They haven't all done well. Inverse ETFs and currency ETFs are two that come to mind that haven't done well. why have they struggled compared to some of the other thematic ETFs, such as tech ETFs?
Well, look, my first point I would say to any investor is understand what you're investing in, because the label doesn't necessarily tell you what's under the bonnet. And it's some of those structures that sit behind some of the products that you're talking about are quite complex. And to go into those investment solutions without understanding, what can happen in market downturns as well as the ups is really important. And that's one of the key rules I would say when looking at an ETF is understanding what you're investing in and looking under the bonnet. Now, as we know, all investments have their time. They've also got very long, most investments, particularly of the high risk nature, have a long investment time frame. So I would say to you that if it's not looking great today, then you need to look at the longer term, because I would suggest that an investment like that would be a 5 to 7 year time horizon.
So those very complex ETFs, such as inverse ETFs made up of derivatives and futures contracts, do they have a place among mum and dad investors, retail investors?
It comes down to choice at the end of the day, but what I would always say is seek advice. If they're complex, and as you say, they're complex investments, if you don't understand them, ask the question. And it comes back to what's your ultimate investment goal as well, and what's your time horizon, just to make sure that you're aligning the product that you're choosing with that investment time horizon. And if you've got the time, then maybe it is the right product for you, but I think you just need to make sure you've got the understanding.
Do you think it is better to start with market indexed ETFs and then move to those those ETFs on the periphery, those gold ETFs, those other thematic ETFs?
Look, I think it comes back to your investment profile. My investment profile versus my 22-year-old daughter's investment profile is completely different. And she's got different ideas of how she'd like to invest versus what I have when I'm planning for my retirement. She's planning for saving for a house, for example. So I think that what it comes back to is understanding your goals and needs, and what does that portfolio look like? Do you start off with a balanced portfolio to begin with? And one of the principles of financial planning is using core and satellite approaches. And that core could be a passive investment option that might be available to you, whether it's in the ASX 200, 300, whatever that might be, or a balanced portfolio. But then you can do the tilts around the edges, which could be investing in commodities or some of the technology stocks and so forth. But again, I would say to you that you need financial advice, and understanding what you're investing in is really important.
A lot of those thematic ETFs, such as the FANG ETFs, the tech ETFs, they sound very sexy and new age. Can that be a problem for investors who just rush to something they think is attractive, but might be hiding some skeletons in the closet, so to speak?
I don't know if it's about skeletons in the closet, but I think it's like advertising and marketing is fantastic. And it can be, that's done for a reason, to attract you to a product. But again, it's about understanding what you're investing in, I think. And it's not just about what are the 20 companies or the 50 companies that you're investing in underneath, but what's the index methodology? So if it's tracking an index, whose index is it actually tracking? What do they do? How are they charging you a fee? And what is that total cost? Because it's not just about, one of the things that sometimes investors forget is they look at it, the marketing's fantastic. They look at the fund and it might tell you that it's, it's 20 basis points, but how much does it cost you to trade? And that's the total cost of ownership as well, which is really important for investors to also make sure that when they are doing that due diligence, with all of the marketing and all of the good things that come with it, to make sure that you do get that research and do the research and understand what the actual the cost is to trade that ETF.
To that point about transparency, do ESG ETFs sometimes have a problem with greenwashing?
Look, I think transparency, ESG ETFs are all, there's an E and an S and a G, and how that actually comes together is different for all of the different products in the market. A lot of it goes back to the index that they're tracking, and it's really important to recognize that it's not just the E that sits in an ESG portfolio. It is also, and that could be one contributing factor as to why a company is actually included in that portfolio. So it's really important, and that comes back again to understanding the methodology. And sometimes and that's freely available via the issuers' websites. You can also go through to the index providers' website, but truly understand what's that approach to adopting the ESG philosophy within the portfolio.
Looking forward, what can we expect from the ETF market generally and State Street specifically?
I think if we look at the last 5 years, so if we go back 5 years, 2016, the ETF market has actually grown. It's fivefold to where it is today. Now that's significant growth. If we look at where we sit as an ETF market in Australia compared to our counterparts, so remember I said to you at the beginning that the ETF market was established in the US. Now, if we look at our compound annual growth rates in the Australian market, so for 1 year, our compound annual growth rates as at the 30th of June this year in Australia was 61.85%. In the US, it was 48.41%. Now, that's not to say that 48.41% compound annual growth rate is not great. But if we look at that's 61% sees that there's going to be significant growth. So what we're seeing is forecasting out further. So after 5 years, it's 33% for Australia. And looking at a 10-year average is about 28%. So we can see continued growth. And that's where forecasting from an Australian market perspective that our market will double from $110 billion to $220 billion in the next 3 years. And that's because of the number of issuers coming into the market. There's been a shift in the Australian market too. There's new products coming out, so when we go back 20 years, it was about market cap ETFs that were being brought to market. But we've seen that evolution. You were talking about managed funds before. Now we've seen the evolution of the exchange traded managed fund coming to market and the number of issuers bringing those to market. What that's done is actually increased choice, but also increased the size of the market as well very quickly. And I think we'll continue to see more of that too.
Do you think it could be a dangerous thing having so much passive money going into the market come the next financial crisis? Passive money and will also be passive money out?
Well, you've got to remember that ETFs are born out of a crisis. And an ETF, the liquidity of an ETF is as strong as the underlying constituents. So the amount of money that's actually invested in passive, as you were saying, passive products is only a relatively small percentage to the overall size of the market. We're looking at a market cap of the Australian ETF market of only $110 billion versus the Australian market cap of the ASX, which I'm not sure what that actual number is, but it's minuscule compared to the size of the Australian market.
Meaghan, thank you so much for joining us on Friends with Money. We'd love to have you back on soon. This has been a great chat.
Thank you so much. Appreciate that.
We've been talking to Meaghan Victor from State Street Global Advisors. You can subscribe to Friends with Money wherever you get your podcasts, and be sure to check out our online content at moneymag.com.au.
Thanks for listening to the Friends with Money podcast. For credible, independent and easy to understand financial commentary, visit moneymag.com.au.